Imagine an institution that can create trillions of dollars, move global markets with a single sentence, and quietly shape the economic future of entire nations. Now imagine this institution is not really a bank. No customers, no savings accounts, no credit cards, no branches on your street. And yet, its decisions can determine whether businesses survive, markets rise, or economies fall. This is the story of the Federal Reserve, the most powerful financial institution in modern history, and why it breaks almost every rule you think defines a bank. Welcome to Inside Finance History, where money, power, and history collide, and where nothing is ever as simple as it looks. When we hear the word bank, we imagine something familiar, a place where people deposit money, a place that lends that money to others, a business that earns profit from interest. Banks compete, they advertise, they try to attract customers, they are part of the market. But the Federal Reserve does none of these things. You cannot open an account at the Fed. You cannot apply for a mortgage from the Fed. You can't even walk into a Fed branch and speak to a teller. So why does it look like a bank if it doesn't behave like one? The Federal Reserve is not a commercial bank. It is a central bank. But even that description does not fully capture what it is. The Fed does not simply operate within financial markets. It defines the conditions under which markets exist. It sets the cost of money. It controls the supply of liquidity. It acts as the lender of last resort when the entire financial system begins to tremble. In moments of crisis, when trust evaporates and panic spreads, the Fed becomes the ultimate backstop, not by competing with banks, but by stabilizing the very foundation they stand on. This is not the role of a normal bank. It is the role of an institution designed to prevent economic collapse. Here is where the story becomes more unsettling. Most people believe banks simply move money. They imagine a system where savings are collected and then redistributed. But modern finance does not work that way. Commercial banks create money when they lend, and the Federal Reserve creates the conditions that make this creation possible through interest rates, through reserve requirements, through policies like quantitative easing. In times of crisis, the Fed can expand its balance sheet by trillions of dollars, not by printing physical cash, but by dividendally creating liquidity. This is not counterfeiting. This is policy. Commercial banks move money. The Fed shapes the environment in which money can exist, and that difference changes everything. The Federal Reserve occupies a strange and often misunderstood position. It is not fully private. It is not fully governmental. Regional Federal Reserve banks have shareholders, yet the institution serves a public mandate. Its leaders are not elected, yet their decisions influence unemployment, inflation, and growth. It operates largely behind the scenes, yet markets around the world react instantly to its words. It is perhaps the most powerful institution that functions without daily public visibility, and that paradox fuels both trust and suspicion, because power that operates quietly is often the hardest to understand. To understand why such an institution exists, we must return to the early 20th century. The United States once experienced repeated financial panics. Banks collapsed, depositors lost their savings, credit froze. Economic life could stop almost overnight. The Panic of 1907 was especially severe. It revealed a terrifying truth. Modern economies had grown too complex to survive without a stabilizing force. In 1913, the Federal Reserve was created as a response to chaos. Its purpose was not to dominate markets. It was to prevent systemic breakdown. It was born not from ambition, but from fear. Over the decades, the Fed's influence expanded far beyond American borders. Because the US dollar became the world's primary reserve currency, the Fed's decisions began to ripple across continents.
Interest rate changes in Washington could influence investments in Asia. Liquidity policies could affect debt markets in Europe. Crisis interventions could stabilize global trade. In an interconnected financial system, monetary policy became a form of global gravity, invisible but undeniable. So is the Federal Reserve the most powerful bank in the world? Yes and no. It is powerful not because it holds the most money. It is powerful because the system believes in its ability to maintain stability. Money itself is built on trust. Financial systems are built on expectations. And central banks exist to protect that fragile confidence. The Fed does not control the world simply through policy. It influences the world through belief. Because as long as people trust the institution that manages money, the system continues to function. But the moment that trust disappears, no balance sheet, no interest rate, no policy tool can fully contain the consequences. And that is why the world's most powerful bank is not really a bank at all. We hope the Inside Finance History team has delivered both engaging and thought-provoking insights. Please subscribe to stay informed about our future content.